example as to why, a huge price drop
doesn't necessarily equate to more risk.
Does not equate to more risk.
Yeah.
For the long term. We're Compound Everything, and we talk money and markets, and today we are talking about risk and volatility.
Yes. We were talking a little bit earlier about volatility in the markets and whatnot, and how that doesn't necessarily equate to risk.
Right.
And so one of the risk measures that's often used is a measure called beta. And so what beta is a correlation of the underlying stock price and its historical movement relative to some sort of benchmark performance.
The S&P or something.
So typically what is used is the S&P 500 index. And so you take the price movement of the stock and correlate that to the S&P 500, and a higher beta, or a beta of 1 means it mirrors fairly closely the S&P 500.
With the broad market.
Right, so if the broad market goes up, it'll move in a similar amount, and if it goes down, it'll also go down in a similar amount. Beta of less than 1, so 0.5-ish, means that it should move less than the overall market.
Right.
So the market swings high, then you won't see quite as much of a swing up. If it swings down, you won't see quite so much of a swing down. And so it indicates historic, and that's the important part, historic price stability,
right,
relative to a benchmark.
Right. Now, the reason a lot of people use beta is because they think it takes the risk out of their portfolio. And that's a big reason why there's a lot of people who love index funds, because you have 1,000 or however many stocks you have, and with all of those, if one stock is very volatile, then the other one should make up with it. So if one stock goes out of business, or just like the rest of your portfolio should be okay. Beta
is also used, in my understanding, by portfolio managers as a kind of an additive. So when you're looking at adding stocks, so in order to reduce volatility of the overall portfolio of, let's say, 20, 25, 50 stocks, however many they have, they might add certain stocks with a higher or lower beta to try and achieve market correlation, generally, on average.
Now, this is my own personal thought. I actually think beta exists because it's an easy question to ask for teachers.
Fair enough.
And I think a lot of the educational system is like that, not only in finance.
Yeah.
I think many things that become very popularized in education are there because it makes the teacher's job easier. And beta is one of those things that's really taken off, and people love it, and it's part of modern portfolio theory. Right?
Yeah, and it's used in the capital asset pricing model to try and develop.
Exactly. Again, very easy to mark.
Right, yeah. So in terms of trying to develop valuations for equities and such.
Seth Klarman says that, I think his exact quote is, beta is preposterous.
Yeah, and I agree. Generally speaking, I'd agree, because so a stock that has appreciated 5% year over year for 5 years will have a lower beta and therefore a lower risk than a stock that's increased by 20% one year, and then 40% another year, and then 10% the next year, and then 50% the following year.
Right.
Which stock would you rather own? I think I'd rather own the latter, even though it's a higher beta and they therefore classified as lower risk.
And that's why Warren Buffett as well is not really a believer in beta.
No, for another reason. Go ahead.
Yeah, and he was just saying, or he has been interviewed, I should say, and he talks about the Post.
Yeah.
And he just says how, it was worth X amount and you could buy it. I can't remember all the numbers.
He said 400 million. $400 million.
That's what you could buy it at.
Yeah.
As a whole.
Well, I think he said any reasonable investor would have paid about $400 million for the Washington Post at the time.
And then he says...
And it was trading at 80.
And it's trading at 80, exactly. Yeah. So he said, was it now if he had, woken up the next morning and it was all of a sudden trading at 40 million, would that make that investment more risky? And he was like, no, that would make that investment better.
Right, much
because
less
now
risky.
I'm getting this company for even cheaper, and it's a cash producing company, or I can't say if it was a cash producing company at the time, but it's this company that owns all this stuff and it's worth X amount.
Yeah.
So that was his example as to why a huge price drop
doesn't necessarily equate to more risk.
Does not equate to more risk.
Yeah.
For the long term.
For the long term holder.
And that's the
bottom line. And I wonder whether or not we're not big fans of using beta, so we don't use it in our calculations
It doesn't even
of
cross my
intrinsic
mind.
value. No, unfortunately.
There's one value investor who does use it.
Oh, who's that?
Ashwat Damodaran.
Yes, that's true. Actually, he does use it. He finds it very important.
Yeah.
No, I knew that. That's
Kim
funny.
K of value.
The Kim Kardashian of value invest. So the point being is we don't use beta, but oftentimes when I'm looking at stocks on my stocks app, it flashes up, and which I honestly wish it wasn't there. Maybe there's a way to turn it off.
Yeah, exactly, because it just doesn't matter at all.
No.
And so, I mean, here's the thing with long-term investing. So you think of Meta recently. Now that stock, what did it go up to?
I think the high
something.
was $380.
You know, and now it's down. Today it's 160 something.
Yeah.
And it's been 150. It's been back up to 200.
Right.
I mean, I don't know what its beta is, but you could say it's been a little bit volatile as of late.
Oh, no question.
But it would make, you know, if you've done your valuation and if you think that company, you know, is going to be worth $300, maybe $400 in a certain amount of time or whatever.
Yeah.
The 150 price.
Yeah.
Is a fantastic thing, and in fact, more volatility would be. I would like more volatility because I'd like that thing to drop under 100.
Right. Well, and that goes to another point there. I haven't calculated the beta, but it would be interesting to see what the beta calculated of Facebook was when it was trading at $380 relative to what it is now.
And the whole market.
And I would almost guarantee that the beta now of Facebook is probably higher than it was when it was 380.
Exactly.
So therefore, implying that it would carry more risk as an investment, which, if the investment is dropped and it's still a good investment, which we believe it is, not investing advice, then the investment now is less risky than it was at $380,
exactly.
which is preposterous.
And I can't remember who said it, but they were saying the problem with beta is that it actually doesn't use fundamentals.
No, it doesn't.
And one of the things that makes an investment risky is when you are investing in something that you don't understand, right? And you're putting a lot of capital in hope.
Yeah.
Right? You're putting a lot of your own money in the hope of a company doing something they have no fundamentals. Maybe they have a lot of bad debt. Who knows? You know, and you're just thinking like maybe it's a pharma company, for example, if there's a breakthrough.
Yes.
Right? That's risk.
Right.
But if you follow the fundamentals, there can be some companies that move and gyrate a lot, but they're good companies if you look at everything. And that's short term.
Yeah.
So right now we are in a pretty volatile market. Things are going up and down like crazy all the time.
Yeah.
So really, everything's kind of volatile.
Yeah.
But in the long run, some of these companies are going to be just fine because they're not going to follow this pattern of volatility. What they are going to eventually follow are their own company fundamentals. And that is what makes a company risky or not risky, is what are they doing as a company.
Right. And to further that point, risk comes from not knowing what you're doing.
Yes,
and you can't get rid of that with a number called beta. So you either know the company or you don't. And if you don't know it, don't invest.
Right.
Bottom line.
Right.
So the other thing that you mentioned, Ashwat Damodaran, I wonder, him being a fan of beta, I wonder if part of the reason why he is such a fan, and this is just my thinking, is part of the reason he's such a fan of beta is because he's called on oftentimes to give valuations of companies.
That could be.
Right. So he's constantly having to give valuations. But perhaps someone like Ashwat Damodaran having to give more up-to-date valuations and stuff like that. And also like that. So investment bankers and stuff, they may have to give more kind of up-to-date valuations.
See, and in my mind, that goes back to the whole idea of the teachers like it.
Yeah.
So whether beta does anything helpful as to how much value a particular stock is going to add to your portfolio, if you didn't do it right, you will get in trouble.
Yeah.
But even if your pick goes down, if you ran the right calculation and you used all the right banking metrics, then you're good. You can be wrong with the crowd. And if the crowd likes beta, then you're okay.
Yeah, because that's how everyone else would have calculated.
That's how everyone else thinks it. But the idea that beta works because it has this one number at this one moment in time makes zero sense for the long-term investor. Because what does a beta number mean in 2022 when you're going to hold it, hopefully,
till 2032?
What does that number on that one particular day have any bearing on this? Right. But to circle back to the volatility aspect, Warren Buffett, he always just says that what risk really is and what they're trying to avoid is not losing capital permanently. Right. And if he doesn't think that it will be a permanent loss of capital, it's not a risk. Right. And it has nothing to do, every single stock he looks at doesn't have anything to do with volatility. It has everything to do with will this money end up being a permanent loss of capital, or will this money grow?
Yeah.
Will I make more for my investment?
Well, and a lot of value guys like Seth Klarman, I read a quote by him recently saying that would he rather have potential of a large return, or would he rather have almost certain guarantee of his capital, and he'd take the latter every time.
Okay, say that again.
He said that would he rather have a uncertain possibility of a huge return, or would he rather have a near certain guarantee of return of principal, and he'd take the latter every time.
Exactly.
Because the point being is, if it's kind of like gambling in a sense, if you don't have capital, you can't play anymore.
Yeah, actually, this is a side note. A lot of very successful value investors, also were gamblers.
Yeah, I believe that.
In the sense that they only played games where there were actual probabilities.
And the probabilities were heavily weighted in their favor.
Yeah, Thorpe, Templeton. I think Templeton was a poker player. And
yeah.
It actually there's actually like a little bit of a correlation.
So go back to risk for a second. Risk then isn't necessarily the volatility of any stock or given equity. It's, do you have an edge in that business or not? Do you understand the business, and do you understand that the business is stable, going to be there 10 years from now? Or if it's a business that maybe looks like a value because it's trading at a very low discount, does it deserve to be there?
Right, exactly.
Right? So some businesses, when they drop in value, deserve the drop.
Yeah.
And so in investing, the risk comes from not knowing.
Right. And risk is not, volatility is a gift to the value investor.
For sure.
It is just such a gift because it gives you an opportunity to get into these great companies at dirt cheap prices.
Yeah. Well, and double back to a company like Washington Post that Warren Buffett said, you could expect anyone reasonably to pay $400 million for, was trading at $80 million. I mean, you turn a few pages through their annual report at the time probably, and you could have figured that out yourself if you looked. Are there businesses like that you can see? Right, and then it doesn't matter if they drop farther.
Right, and
you can drive by and see they have a factory, and in your hometown, and you can tell, well, that factory is probably worth X million dollars.
Right, or we could see Tim Hortons. We talked about that last time when they plunged in 2008 or 9.
For sure.
And we could see that they were being built everywhere.
Yeah.
Right, and so all of a sudden, this company that plunges looks super volatile.
Right.
Right, but you're looking and seeing what is the probability.
What is the probability of this business going belly up?
So what really makes where risk really lies is when your probabilities are low.
Right. The probability of achieving a return, or at least the very least the return of principal, is low.
Right. Exactly. So that's what's really risky.
Right.
Right. Is when your probability is just so low, and you're thinking, and you're just kind of going on hope.
Yes.
Or going on a hunch.
Yeah.
Right. That's what's really risky. Yeah. But volatility is just not necessarily a risk factor for the long-term investor. It's definitely a risk factor for the short-term investor.
Oh, for sure.
And I think it also comes down to the reason why volatility in the finance world is looked upon as so risky is because most professional investors are not long-term holders.
Yeah, the churn is huge.
The churn is huge, and I think I've even read that most mutual funds hold very few of the same assets a year later.
I would believe that.
I think it was like 18 months or a year, but there's very few of the same. It looks like a very different fund.
Right.
Within a year. That is not like long-term now is anything more than 6 months.
Yeah.
Right? Or maybe anything more than a year.
Yeah.
Right? So.
But business takes years to play out.
Business takes years. But it makes sense when you're in an industry that's moving fast, that volatility matters.
Yeah. That's
right?
True.
And so you have to look at that. But unfortunately, that very popular train of thought has overtaken the investing world, and it has misguided a lot of people.
Yeah, I believe so, and individual investors inclusive.
Exactly. Yeah, and it's almost like a flywheel, I guess, as you would say, because volatility. Something's volatile because we're short-term investors, but now it's more volatile because of short-term investors. So we get out, that makes it more volatile. We become more short-term, and
it's a flywheel effect.
On and on it goes. Yeah. But because there's this weird thinking in the finance world that volatility makes something more risky, it allows the value investor to have a real edge
Yes.
And that's what we kind of want to say, is that as a value investor, the idea that volatility is risky and makes all these big players run, right? All these guys are running out of these investments. That gives the value investor who's willing to hold a position for years and decades a real edge in investing.
Yeah, I believe so. No, I think you're right. One of the other things Warren Buffett has said relative to investing, he says, in any given year, we don't know whether a stock is going to go up or down. And the point being is, in any given day, if you were to buy Coke today and sell it tomorrow, that's a risky investment, right?
Yeah.
But at the time he bought Coke in the 1980s, and if you hold it for 10 years, that wasn't such a risky investment.
Exactly. And that's why a lot of the real estate guys do well. Not
But it's a forced holding period.
But that's what I mean. Like, it's almost like they do well, not because they knew okay, maybe they know what they're doing, but it's not they do well because they know what they're doing in full. It's because they're not turning around and selling their asset in 2 months.
If the I think, to add to your point, if the liquidity was higher, then meaning you can buy and sell a property like you could a stock, people would do a lot worse than real estate.
And of course, in real estate too, you can overpay.
For sure.
Right? But because you're holding, if there is this vicious drop, you hold it for 20 years, probably you're at the very least going to break even.
Chances are you'll be
right.
Okay.
But when you can't open up your real estate portfolio and see the exact mark to market.
Right.
That's the problem.
Right. On our real estate portfolio, it's an estimate.
Exactly.
We don't know exactly what we get for our real estate.
But you can open up your portfolio and see the absolute, and that makes people panic.
Yeah.
You have stop losses, which of course also add to volatility.
Right.
And all of these things. So if you can hold, you have an edge.
Yeah,
there
it
are
makes
so
sense.
many things in the stock market that make them so much more volatile than any other asset class. You have options.
Yeah.
Stop loss, because we mentioned stop losses.
Yeah.
And that's why you have all this craziness going on.
Right. There's a lot of push and pull in the markets that don't necessarily have to do with fundamentals.
And that's why if you can just step back and breathe and stick the course. And I think what must be hard for investing, because even Manish Babrai has said, like, you don't need Excel to find a good value. Like, it should be such a screaming value that the value investor just knows.
Right.
Right? But I think what makes it hard is the stick-to-itiveness. It is hard. It is hard to stick with your stocks when they are volatile.
For sure.
Because you're seeing this 20% drop. You're seeing this 40% drop. It's hard to stick with it. It's also hard to buy a stock sometimes when you see all of these people running out of it.
Oh, absolutely. It takes a lot of mental fortitude. And that's why John Templeton said he did better the farther away he moved from New York.
Yeah. And so if you can get past that volatility, if you can have a strong mental game, then you can use the volatility in your favor.
Yeah. So to summarize, we don't like beta as a measure of risk. We don't use it in investing. I mean, for our type of investing, we don't see much point. Secondly, we think that and know that risk is more tied to our ignorance than we do to some number, i.e. beta or whatnot.
Risk is not knowing. In the
risk
words
is not
of Warren
knowing.
Buffett, risk is not knowing.
Right. And then thirdly, we try to invest more based on probabilities, more than based on beta or things like that.
Yep.
And what is the likelihood we're going to get our capital back when we make an investment?
Yeah. And I think fourthly, and this is one that's often overlooked, is that volatility is what the value investor needs in order to
capitalize on.
We need a company to plummet. We need a company to be volatile at a moment in time in history in order for us to get in at a good price.
If there wasn't a rationality in the market, then there would be no value investing.
There would be no, if the market was in fact efficient, there would be no value investing.
Right. No, I think that's a great summary.
Yeah. So that's everything we have today. If you have any comments, you can leave them below. Remember to like and subscribe, and we will see you next week.